Welcome to CSIS Online. The way we bring you events is changing, but we'll still present live analysis and award-winning digital media from our Dracopolis Ideas Lab. All on your time, live or on demand. This is CSIS Online.
Hi, this is Rick Rosso. I hold the Wadhwani Chair in U.S. India Policy Studies at CSIS. Sorry for a slight delay, some technical issues on our side, but it's great to have everybody live and online. This is actually the second year in a row that we've had this terrific panel come together. Last year, of course, we were able to do it live and in person in the on stage at CSIS, but of course things are very, very different now in terms of how we operate our events and most of our daily lives. I think the conversation a year ago, too, was dramatically different. We were talking about some of the initial readings we had from a newly elected Moody government with even a larger mandate, and some of the priority areas that we thought the Moody government would focus on during its second term, some of the key issues that we were tracking to see whether or not we would see in India that would return to 7-8% growth, or one that would remain for some time at 4 to 5% growth. So that was a year ago. Today, of course, the conversation is quite a bit different. How will India and of course the world survive and keep the economy moving to some extent during COVID? But also importantly, how do countries prepare themselves for what the post-COVID environment is going to look like? Is there going to be big infrastructure build spending coming out there? Reforms? Are companies really going to look for alternative markets for manufacturing, beyond China and places? And can India begin to attract a larger share of that global investment that otherwise they'd been to a large extent missing? From our own work at CSIS, we have this reform tracker where we look at the 30 biggest reforms pending when a government takes office. And during its first year in office, when it took office back in 2014, the Modi government actually managed to get 6 of the 30 reforms across the finish line in its first year, including some big ones like oil and gas reforms and abolishing this reserve small-scale industries list. In its first year of its second term so far, we've seen the pace of big reforms slow down. Only one of the big reforms that we've been tracking so far, which was a major tax cut to bring India's corporate tax rate more in line with some of the markets against which it competes for investment. But here to kind of unpack a little bit more in terms of what's happening both in the globe that India should be tracking, but of course things in India specifically, are 3 terrific friends of mine. Stephanie Segal, who's a colleague here with the economics chair at CSIS. Stephanie, of course, is a former Treasury official, also having served both at the IMF as well as with JP Morgan. Joydeep Mukherjee with Standard & Poor's Global Ratings, and Joydeep, of course, is one of my original gurus 20 years ago when I started at the U.S. India Business Council, helping me learn even some of the own things I was handling that I didn't truly understand myself. So Joydeep's been really a friend and a mentor for a long time. And Bill Foster, who's a Vice President and Senior Credit Officer at Moody's Sovereign Ratings. Bill obviously is no stranger to India. He served in India on behalf of Treasury Department as attaché, among other roles that he held at Treasury before taking over this great role at Moody's. So let me first hand the floor over to Stephanie to kind of set the stage a bit with the global view, and then we'll look to Joydeep and Bill, who will talk about things that they're tracking in India, and then we'll open it up for some questions. So Stephanie, the floor is over to you.
Great. Thanks a lot, Rick, and thanks again for the invitation to be with everyone either this morning or this evening. I'll just give 5 minutes or so of background on the global macro outlook, and then hand over to Joydeep and Bill. So as folks will know, since the WHO declared formally a pandemic in mid-March, the global growth outlook has deteriorated significantly. The latest Bloomberg consensus forecast has global GDP shrinking by about 3.5% this year before rebounding in 2021. I'll spend a minute or two here just talking about a slightly more dated estimate of the global growth outlook, which was from the IMF back in June. And I'll focus on this just because of the magnitude of the downward revision, and also how comprehensive it was, pretty much impacting every country that received an update. So back at the end of June, the IMF updated its global growth outlook from its forecast just 2 months prior, and revised growth downward by 2 percentage points. So it is actually much more pessimistic on the global growth outlook than the Bloomberg numbers I just quoted to you. They're looking at around 5% contraction for global GDP through the end of the year. And for the group of countries that it revised growth outlooks for, of about 30 countries, it was virtually every country that was revised downward, 28 of the 30. And India in particular, I think, stands out as the country that had the largest downward growth revision. There's a better outlook, obviously, for 2021, but in very few cases are we seeing any evidence of this V-shaped recovery. And folks will know a few months ago, a lot of the debate, I think, was focused on the shape of the recovery. I think that debate is, for the most part, over. It's now a question of how prolonged and protracted the rebound will be. There may be an exception to this, and it is in Asia. I think to the extent we see anything that looks remotely like a V-shape, it is in China and also to some extent in Vietnam. So two countries that, notwithstanding where the pandemic itself started, have actually managed to get the outbreak under control, and economic growth has recovered as a result. So China actually is forecast, not according to everyone, but according to most estimates, is actually forecast to experience positive growth for this year. And that's on the heels of a contraction, annualized contraction in Chinese growth in the first quarter of about 10%. At the other end of the spectrum is the United States. We were talking just before we went live here about the very different health outcomes that we're seeing in the United States relative to most other advanced economies. And as we've been saying since the start of the outbreak, this is really a story, a public health story, and the economic outcomes follow from that. But it is first and foremost a health story. And given what we've seen, which is the continued spread of the virus, we're not seeing a robust economic recovery as had been initially forecast. So the US economy contracted at an annualized rate in the first quarter of about 5%. In the second quarter, it was nearly 33% annualized contraction. And while we are forecast now to have positive growth and a rebound in the third and fourth quarter, the rates of growth are not sufficient, obviously, to create this V. And I think the more jarring statistic here is that analysts aren't actually expecting the US economy to return back to its pre-crisis potential GDP level for many years to come. And so again, this kind of speaks of the strength of the recovery that has to be founded on the health piece. And there are a lot of questions and uncertainties here, not least the science and technology piece of it. So what's the progress with treatments and vaccine? And until we have answers to those questions, it's hard to predict really with any accuracy how the economy will follow. Just a few minutes on the policy response. We've seen in the US and actually globally very accommodative monetary and fiscal responses and very rapid fiscal responses, which stand in contrast to the global financial crisis. So just to throw out a few numbers there, on average among the G20 advanced economies, we've seen an excess, this is again on average, of 10% of GDP in above the line fiscal support, and another 12% on average of below the line support in the form of guarantees. For G20 emerging markets, a smaller response, but also a massive response in comparison to previous crises. So G20 emerging markets have responded on average just shy of 5% of GDP in direct support and another 2% in below the line measures. And this level of support, unprecedented, also, I would think of it as a bridge. This level of spending is in response to the sharp contraction that was the result of the containment measures. But I think it's also accurate to say that it can't be kept going indefinitely, which makes the solution on the health side essential. And the flip side, or the result of these very aggressive spending measures, is that economies are then going into larger deficit positions which then leads to debt buildup. And so I'll end my comments here with just a bit on what we're thinking of as legacy issues related to the economic crisis. And debt overhang is kind of the one that's first and foremost in our thoughts here. A number of economies, including the United States, is going to come out on the other side of this crisis with a debt to GDP burden in excess of 100%, well in excess of 100%, and actually at a record level that will even exceed where we were coming out of World War II. This raises questions about how that is financed. It raises questions about the fiscal dominance and what it means for the path of interest rates. Because with debt burden so high, it's possible at this moment now when interest rates are at record lows, but that also presents future challenges, because once interest rates start to tick up, then you have other things that you need to start worrying about. And so I think there's a lot of discussion about kind of this link between fiscal and monetary policy and what it means to have to keep interest rates low in order to finance the debt. There are initiatives when it comes to some of the lower income countries and how to deal with their increasing levels of indebtedness. The G20 a few months ago agreed on a debt service suspension initiative, the DSSI. There are 70 or so countries that are eligible for that treatment, which would effectively suspend debt service through the end of the year, but not necessarily forgive debt. There are questions now as to whether or not that will be sufficient. And I think the majority of analysts looking at a number of countries have concluded that that will not be sufficient. And so there will be a need for some further treatment, and hopefully Bill and Joydeep may have some thoughts on that. And there's a question of the way forward when you have that many countries that are going to be facing these very precarious debt sustainability positions. What does that mean for their future growth outlook? What does that mean for the investors that are holding that debt? So that is one clear legacy issue that we'll be grappling with on the other side of this crisis. The other is in respect to inequality. And here I would just say inequality has been identified as an issue in the United States, but also globally, and the problem of widening inequality before the crisis. The health crisis has revealed, I think, just how profound some of those inequalities are. And the immediate impact of the crisis is actually to exacerbate those inequalities. So we've seen portions of the labor market for lower wage jobs that are being disproportionately impacted by the crisis. And there's a question then of what is the accurate or the correct policy response to deal with those folks that are more acutely impacted by the crisis. There's a related question that is the fact that the crisis itself has actually just accelerated changes that were already underway. And certain sectors, including sectors for some of the lower wage paying jobs, may not actually recover. Retail is the one that's mentioned kind of most often as having a big structural kind of reform underway that the COVID crisis has really just accelerated. And will retail jobs come back? And if the answer to that is no, then what is the outlook for those people that were previously in those retail jobs? So there will be a need to then deal with this impact of widening inequality, thinking about job retraining for those people. But I think answers to both the debt question and the inequality questions are going to be critical, not just to the near-term outlook, but over the medium term. And with that, I will turn, I think, Joydeep, you're up next.
Yeah, thanks, Stephanie. Yeah, Joydeep, great that you could join, and floor is yours.
Thank you, Rick, and thank you for inviting me to participate in this program. And I echo your wish. Last year we met in Washington. I hope next year we meet in Washington, rather than everyone staying at home in their study or bedroom. So let me outline our view in S&P Global on India's sovereign rating, and then go beyond that into talking about the issue of economic growth, because this is really the key to many things. And I think my colleague Bill Foster will outline their views, and hopefully there's some differences that can lead to some interesting questions. I think to start off with, this is sort of a big picture. We rate about 135 countries around the world. The upper half of our rating scale is called investment grade. The bottom half is called speculative grade or non-investment grade. India's rating is BBB-, which is an investment grade, but it's at the very lowest rung of investment grade. And we have a stable outlook on the rating. And I think Moody's has a different view, as Bill will probably explain. The rating is, let me back up. India is the poorest country in terms of per capita GDP to be in the investment grade category, which speaks to something in terms of most countries at that level of wealth are simply not well managed enough that they would get an investment grade rating. Now, what holds up the rating and what brings it down? I think everyone in this call, if they follow India, is aware of the debt issue that Stephanie just mentioned. And India's debt burden, government debt burden, is quite high. It will probably exceed 80% of GDP this year. And that's constraining the rating. The debt is caused by large deficits, and that is also constraining the rating. But there are other factors that are supporting the rating. There's a reasonable amount of monetary flexibility, of exchange rate flexibility. India's external position, if you're looking at all the assets and liabilities held by Indians or owed by Indians to the rest of the world, that's in a fairly comfortable position. And that's an important variable for us, because that external vulnerability often leads to debt crises, especially we've seen in countries in Latin America. India really doesn't have that. And the key to holding up the rating is economic growth. And if the Indian economy were to grow at a lower rate on a trend basis, the rating would be lower. But India's growth rate, going back really decades now, has been well above the growth rate of similar sovereigns at a similar level of development. And this is the key, I think, for the analysis going forward, because if growth is good, it spills over into everything else, and all the other numbers look good, and the rating stays in investment grade or potentially moves up. Conversely, growth is bad, everything else starts looking bad, and then you can have a downgrade. We have a stable outlook on our rating, which means that we think that the growth rate will get back up near the levels that it used to be a few years ago. Not just because of a recovery next year. It may not be a V-shaped recovery, as Stephanie was mentioning. And also India's growth rate had been declining in the last couple of years prior to the pandemic. But we think that the growth rate will pick up on a trend basis over the next 3 years, and that's why we have a stable outlook. Now, let me go into some background as to why we think that way. Before discussing anything on India, I think it's best just to set out the ground framework of how to look on it. 2014 was a turning point in India, and Rick mentioned his tracker of the 30 reforms that he looks at. 2014 was a turning point, not so much in economic policy, but in terms of who runs the country. There is a new elite in India across the board that is gradually displacing an earlier elite, which had been running the country for most of its history since independence. This is a smooth, sometimes a little noisy, but peaceful process. And this elite change has caused a lot of polarization in perceptions. Narendra Modi is as much a symptom of this underlying change in India as he is a cause of it, because this elite change reflects changes that have gone on in society really since the early 1990s, when the economy started to grow and the middle class emerged in much greater numbers than ever before. Now, this has led to a big gap in perception. There's one group of people who view Modi, BJP, Hindu nationalism in a very negative way and think that India is going in the wrong direction. There's another group of people who view the same phenomena in either a very positive way or in a more negative way. I'm not going to argue for one interpretation or the other. That's not the role today. But I think it's worthwhile noting that most Western analysts, especially academics and media, have a very negative view of where the country has been going politically since 2014. Most Indians have either a more positive view or a more neutral view. Obviously, there are many Indians who have a negative view as well. But I think the range of views is different inside India than the range of views you would get from people here. Why is that important? It simply means that you have to understand the filter through which we are interpreting things. I'm not saying you should change your filter. Now, what else has changed since then to set the stage for the growth story in the future? I would point to three things: economic policy, politics, and what I would call state capacity, the ability of the state to deliver and do things. On economic policy, very briefly, we haven't had most of Rick Rosso's 30 reforms implemented since 2014. Some have been done. But I think the bigger change that's happened is not a big bang reform, but it's something more underlying, which is that, if I can exaggerate a little bit, socialism finally died in India and was given a quiet burial sometime in the last 6 years. There was never a moment in India where, like in China, Deng Xiaoping said, "It's glorious to get rich." No one said that in India, but I think now what you've seen, not just from Modi, but across the board, is that the focus of Indian discourse and politics now is how to build a more prosperous, market-oriented economy, not the kind of discourse we had in the past. Now, that doesn't mean that that the public sector has been privatized. It hasn't. It doesn't mean that the government doesn't interfere in things that perhaps it should ignore. Those things are still there. But I think what has happened is that the thinking and the mentality is now, how do we build a modern economy without the shibboleths of the old socialist legacy? And this is important because I think what you see now is the government is typically attacked by the opposition and others, not from the left, but from the center or even from the right, meaning on economic policies, it is not attacked for being more pro-market or for loosening up to foreign investment or private investment at home. There are segments where that happens, but generally speaking, the tone of debate has shifted. And I think that's important because as rating agencies, we look long-term. We look several years into the future, and this sets the long-term direction. On top of that, I would add the state capacity. The Indian state was at one time so involved in the economy that you could call it crony socialism. After 1991, with the reforms that I think most of you are aware of, what you saw is India shifted from really crony socialism to what you might call crony capitalism. It was a better state in terms of delivering better GDP growth, but there certainly were many issues of corruption, of government involvement in markets through discretionary means, and many other things which led to a lot of bad results. What we've seen in the last few years is an attempt to move from crony capitalism to a better, cleaner form of capitalism. I say an attempt because this is a work in progress. We're not there at the destination, so I'm not going to exaggerate that. But I do think that there are things such as the insolvency bankruptcy code and many measures to formalize the economy, whether it's through technology, digitization, or through GST. Many things have happened that are basically trying to impose sort of modern, clean rules of the game on the economy. Again, I don't want to go too far and say the work is done. Much has to be done, but I think the direction is clear. And this formalization, digitalization is important because not only does it allow you to have long-term growth, but it also, if you just think about it, suppose the COVID-19 pandemic had occurred 15 years ago, the impact on India socially would have been far worse than what's actually happening now. Because now you have about 330 million bank accounts, no-frills bank accounts for basically very poor people, and several $1 billion worth of transfers went into those accounts just a few weeks ago during the pandemic to keep people going through this crisis. Not everyone who deserved the money got it. There's still leakages and holes and all that, but the bulk of the people who needed the support did get something. This would not have been possible without those bank accounts, without the digitization, without the other steps that have been taken by both the last Congress government and this government in order to digitize India and build better state capacity to reach people. Again, This is not going to translate into rapid growth next year, but it sets the long-term framework for decent economic growth. The third thing I mentioned in terms of what has changed is politics. And again, I would just, in a very general terms, I would just say that the center of political gravity in India has shifted. And I mean, not just the BJP, but I mean across the board, even at the state level. The leadership, political leadership in India is, I would say, more aligned with the outlook and values, the culture of the mainstream of the population. Obviously, there's a diverse population. There is a feeling that the old elite had lost touch in many ways with the Indian ethos, and that the application of its policies, especially the famous word in India, secularism, had been seen by many, many people as being biased or directed towards creating vote banks as opposed to implementing the principles themselves. This is a very contentious issue. I raise it because it's there, not because I want to take one side or the other in this debate. But there was that perception, and now you have a different group of people running the country, not just in Delhi. And this means that the center of politics has shifted. You can have two interpretations of this. One is that India is fixing a misalignment and is basically implementing the constitution the way it was meant to be. Or the other is that this is a dangerous turn towards sectarianism. I'll leave it up to you to decide which one you want, but this is, you have to deal with this issue before you get into data interpretation, because this helps set the tone for how you interpret the data. Now, we have a stable outlook in S&P. The other rating agencies have different views on this. Why do we have a stable outlook on India's rating? Coming back to the topic of economic growth and what's going to happen in the next few years as the world hopefully reemerges from the pandemic. There are certain reasons to be optimistic about the growth rate. There are certain reasons to be cautious about the growth rate. Our evaluation is looking at both sides, that on the whole, we think the economy will recover reasonably well next year. And after next year, it'll probably be growing in the 6 to 7% range. You can come up with any number you want this year. Most people say maybe 5%, maybe a little bit less. Others have a bigger increase next year. Those numbers change. But I think the key is, what is the trend once we get out of this mess? And we're saying it's going to go back probably above 6%. What are the good reasons for that? I would point to the signaling and actions that we have seen during the pandemic. I'm not talking about policies to deal with the pandemic, but post-pandemic policies. So I'll just list them without going into any details. But in agriculture, we saw a major liberalization of agricultural marketing. This had been controlled by the government in a very, very draconian manner. It is basically being freed up. And things like contract farming and new forms of market-oriented transactions are now permitted. That reform has just been announced. It's going to take years to implement, but it was a very good sign. And really, it had nothing to do with the pandemic. The pandemic was a good excuse to do this. In industry, we are seeing a serious effort by the government to try to get global supply chains to shift into India. Now, there are a lot of programs involved, including some subsidies linked to output to get people who supply Apple and Samsung and others to move into India. So far, there seems to be some success in at least engaging with these companies. Let's see, it's too early to say victory or not, but there is a serious effort. And this may lead to a substantial change in the industrial output of the country in the next few years. So it's a possibility. Also, there have been other things like mining has been opened up, and some of the states have loosened labor laws. Again, let's see how well it's done, but it's interesting that these things are done during the crisis and they really have nothing to do with the pandemic. On the services sector, again, some good news. The bad news is this is going to be the weak sector, like it is in the United States, because things like hospitality, tourism, other face-to-face services will suffer. But if you think about it, a lot of people are saying that, you know, in the next 6 months, we're going to do more technology adaptation than we would have done in the next 5 years had it not been for the pandemic. Well, if that's true, probably no country is in a better position with an IT sector to cater to that increased digitization than India is right now. So there's some good news there that's structural and global. Beyond that, I think most people on this call have probably seen that one Indian company, Reliance Jio, has received over $20 billion of foreign investment while sitting at home doing negotiations through Zoom. This has not happened in any other company, any other country in the world during this pandemic. That's a sign that at least that some people are betting big time on the telecom services sector in India. Again, that doesn't mean you can declare victory. It just means that there are signs that growth, once we come out of this recession, can be fairly good because these are long-term structural features. But everything isn't great. There are reasons to be cautious. We don't know, first of all, how long the pandemic is going to last. We don't know what the impact of the US-China conflict is on the global economy and global growth, and the indirect, perhaps, fallout on India could be bad, not just good in terms of supply chains. We don't know about the Indian financial system's ability to bounce back. It was in bad shape before the pandemic. Obviously, it's going to be in worse shape after the pandemic. Does it bounce back quickly, or does it prove to be a long-term constraint on the rating? There's also the fiscal issue, because the fiscal deficit this year is going to be enormous. The debt burden is going to be very high. What does that mean? That means the government has less money to spend on infrastructure from its own budget. So unless you can get the private sector to come in there to spend that money, you may see less infrastructure spending and hence less GDP growth. And finally, there's the issue of trust. This is difficult to measure, but there have been complaints from the private sector about a trust gap between the government and elements of the private sector. You have to be skeptical when people say these things because it could be self-interested comments, but I think there also have been some policy actions in the past, I'm talking many years ago, which have left a legacy of distrust. And that would be key to deal with going forward, because otherwise you won't get as much private investment as needed. So to sum up, I think we're cautiously optimistic that growth will come back. We're not Pollyannish that growth will go to 8%. And one reason to be optimistic is simply that Narendra Modi has tremendous political capital right now. There's no one close to him as a challenger on the political scene. Inside his party, he has tremendous capital amongst the nationalists because he delivered, as far as they're concerned, on the Citizenship Amendment Act, on abolishing Article 370 of the Constitution, on legislation getting rid of instant divorce by Muslims. And although he didn't do it, he's taking credit for the Supreme Court's verdict on the Ram Temple that's now being built. So that means if he wants to make some decisions that may create some problems within his base, I think he can do so because the base is very, very happy with the things that they really care about. Now, crises don't always result in opportunity. We like to think it always does. I would argue that Modi has had the opportunity since 2014. He didn't need a crisis to go ahead with these reforms. However, for whatever reason, he has signaled he's going ahead with this reform. And our base case is that enough will be done to sustain the growth rate, to sustain the rating where it is, and to have India continue as one of the faster growing countries in the world. So thank you, Rick. Back to you, and I guess to Bill Foster.
Great, thanks, Joydeep. And good way to kind of tie in big political shifts and what it means for the government's priorities and ability to bounce back. Bill, over to you. Thanks.
Thanks, Rick. Thanks, Joydeep and Stephanie. Very happy to be here again this year. Why don't I just give you a quick overview of how we see things. There's some similarities and I think quite a few differences from what you heard from Joydeep, but ultimately, hopefully this will foster a dynamic discussion. Basically, from a Moody's perspective, we most recently in June had downgraded India's credit rating from the Baa2 level to Baa3, so it's now commensurate with the lowest rating for investment grade. But we also kept a negative outlook on the credit. And that really has to do with our view that the existing vulnerabilities prior to the pandemic that we saw in India that led us to change the outlook to negative late last year were pre-existing conditions that the pandemic has just exacerbated, they've accelerated. And at this stage, it's very difficult to have a clear view as to what the Indian credit will look like on the other side, to what extent the policy making apparatus in India will be able to on a sustainable basis, deal with these challenges. The three main challenges that we highlighted, that we defined late last year, that were the basis for a negative outlook, and then ultimately for this downgrade, were threefold. Number one, as Joydeep pointed out, growth. We've seen a prolonged slowdown in growth in India, which has been a key feature of its credit strength in years past. We've seen real GDP growth slow in the last 4 years from 8.3% each year down to 4.2% most recently. That was prior to the pandemic. This year, we expect growth to contract by about 4%. This is on a fiscal year basis, and to pick up quite strongly next year, but based on a series of conditions that remain to be seen, and ultimately slow back to a lower potential growth rate in the future, which I'll come back to. But that growth slowdown has many implications and challenges for India to be able to deal with its key credit weaknesses. Number one being fiscal. India's fiscal position is much weaker on a comparative basis to the entire peer group at that level that's just above investment grade, the BAA level. Specifically, the debt to GDP ratio for India prior to the pandemic was about 72% debt to GDP at the general government level. So that's, to be clear, that's the central government plus the states. And that compares to other countries at the BAA level that have a 42% debt to GDP ratio. So the starting point for India going into the pandemic was very weak comparatively on a fiscal basis. We expect that debt to GDP ratio to increase to closer to about 84% this year based on the big hit from the pandemic, and hopefully to stabilize thereabouts, provided growth can sustain itself near 10% nominal GDP growth. But the big complicating factor for India today that we see, both from a growth and then ultimately from a fiscal perspective, really has to do with the financial system. And that was the third variable that we identified as a key challenge for policymakers and for the broader economy that could, if not dealt with in a sustainable and convincing way, would lead to mutually reinforcing negative feedback loops for the real economy and financial system that would result in higher fiscal costs over the longer term and lower growth. We saw a history of legacy issues, twin balance sheet issues, the terminology typically used in India, over recent years, from stalled large investment projects that had been financed in the infrastructure sector that were financed by banks, which inherently there are maturity mismatches there, and ultimately led to the accumulation of non-performing loans on public sector bank balance sheets. And ultimately, that slowdown in those projects also hit the corporate balance sheets. So that twin balance sheet issue really started to hit the economy a few years ago, and particularly public sector banks. The subsequent to that, we had the non-bank financial system also get hit with liquidity issues. And so the challenges in the financial system have broadened out from public sector banks to non-bank financial companies. And more recently, earlier this year, Yes Bank, which is one of the biggest banks in all of India, and a private sector bank, had basic solvency issues and ultimately was taken over by the largest public sector bank in India, SBI. And that has broaden the financial system problems to not public sector NBFCs, but now private sector banks as well. That challenge with the financial system has resulted in a real slowdown in the provision of credit to the economy, which is a key supply side factor to contribute to higher levels of growth. It's resulted in challenges for the government to consider how they're going to be able to provide more capital to public sector banks while also providing necessary support to the non-bank financial system and perhaps private sector banks, which increases the contingent liability risk to the government, meaning risks of higher fiscal costs than are currently anticipated could certainly crystallize and result in higher debt to GDP ratios, larger fiscal deficits. And if that doesn't happen, the real risk is that that growth will slow down further. You'll have a continued weakness on the demand side without sufficient credit. Animal spirits in the markets will ultimately continue to potentially struggle. And this will have, again, negative feedback loops throughout the real economy and financial system that would ultimately lead to a lower growth dynamic in the future and worse debt metrics. And so that's really the key risk that we're seeing in terms of what could happen on the other side of the pandemic for India, and hence we have a negative outlook. It's important to put this into context of how we had previously seen the credit before we changed the outlook to negative late last year. We actually had upgraded India's credit from the current lowest investment grade level to one rung higher, from Baa3 to Baa2 in November of 2017. That was based on the expectation, a series of reforms that I think Jordi had referenced some of them, that the government had announced we thought were very meaningful and ultimately were going to, over time, result in a stronger credit profile or stronger overall economy, stronger fiscal position for India over time. The ones we had identified then were ones that many probably people are aware of: the Goods and Services Tax, the Fiscal Responsibility and Budget Management Act, which is a new fiscal framework with deficit targets to narrow deficits over time, bring the debt to GDP ratio down, which again is India's key fiscal challenge. There's the Insolvency and Bankruptcy Code, which was implemented to try to address these high non-performing loans in the financial system. And there was a whole series of administrative measures and other measures that the Moody administration had put forward to try to improve the overall cost of environment for doing business, the overall investment climate that would hopefully result in higher private sector investment, which had been quite weak for many years based on these twin balance sheet issues and a host of others that you're probably aware of. And ultimately, what we've seen since then really is weak implementation. We've seen, these very important reforms have been passed, but there have been multiple challenges with implementation, and ultimately the results or the intended impact of those reforms has fallen short, and in some cases quite short, of what the original intent was. For example, the GST has not brought general revenues up to the extent or broadened the tax base as had been anticipated. There have been multiple challenges with implementation and dilution of the GST potency over time. One very positive thing is it's brought the fragmented state-based system together into what some have described, and I think is a good way of doing it, as effectively a free trade agreement within India, within Indian states, to one unified market. That was certainly positive and formalized some of the economic activity, but the revenue accretion part has fallen short, which is really important for India's future because of such limited resources that the government has to allocate toward things like physical and social infrastructure. In addition to that, the Fiscal Responsibility and Budget Management Act has continually slipped from its deficit targets. In fact, it's been more or less left behind. It will be very interesting post-pandemic to see what the government chooses to do in terms of readopting those measures and potentially revising the roadmap in a credible way. And the Insolvency and Bankruptcy Code has been very slow in terms of being able to deal with the high NPLs in the system. There has certainly been progress. It's a very important thing to have in place, but implementation has been relatively slow. And the fact is, investment has just not picked up, despite all of these measures that have been put forward. And we see that in the growth numbers themselves. And that has been compounded by consumption that's fallen quite significantly in India, which is of greater concern because fundamentally investment had given India that higher growth level at the margins historically along with exports, but what had been the core, the base, the fundamental driver of growth in India is consumption. It's about 60% of the economy. It's a domestically demand-driven economy, which helps insulate it from external risks, as Jodeep was pointing out. That is certainly a strength for India, in addition to lower external vulnerabilities related to external financing, but endogenous growth from domestic demand. And what we've seen in recent years that's been falling as well. And that raises serious concerns. What are the main drivers of that? How will that be rectified? How sustainable will growth be moving forward? These are all very important questions that need to be addressed to understand the sustainable growth dynamic for India in the future. How much has changed prior to the pandemic, just in recent years, based on structural shifts, and ultimately after the pandemic, what type of permanent damage may there be left behind that policymakers will ultimately need to address through reforms, through various measures that will bring potential growth to a higher level to create the jobs that India's demographics require to meet job creation needs, to build human capital, and ultimately pair that with investment and infrastructure that will result in a higher level of potential GDP growth than what we think is today. Today, we think potential GDP growth has effectively fallen from what had been closer to 8% real GDP in the past to closer to 6% today. India has the potential to have much higher potential GDP growth based on whether there can be reforms toward more flexible labor markets, improving overall human investment in infrastructure, and labor and land reforms that contribute to all these things. So there's a whole host of things we could talk about in terms of the future, but certainly higher levels of growth that sustainably can contribute to the reduction of debt and deficits over time are critical to the future for India, and a stable financial system will be necessary, a necessary prerequisite to be able to deal with that. And those are the things that we're really focused on from a Moody's perspective, and happy to go into any of that in more detail, but hopefully that lays the overall foundation for how we see things, Rick.
Great, thanks for that, Bill. For participants, if you have questions, there is a Q&A chat, Q&A button at the bottom. There's been a few questions thrown in the chat box too. I've been grabbing those, but the Q&A one is a bit easier to sort out the questions from the comments. But we've got a few questions related to renewable energy, to how early did we know about COVID and the states. But I've got a few things I wanted to tee up for our panelists before we open it up for the audience questions. Stephanie, we've talked a lot about COVID and kind of its impact on the Indian economy, but of course there's something else happening in India simultaneously that has also really shifted policymaking in India, which is the flare-up in tensions with China. Now, the United States, really since the election of President Trump, has taken a harder tack on China on trade issues and other things. India is starting to pick that up. You see India putting new restrictions on investments from neighboring countries, banning apps, things like that. So I think those of us like me that kind of live in the U.S. India lane, we see both countries really kind of taking a harder line on China. Is that something that you see kind of happening global right now? Are there really a lot of economies that are lining up and concerned about more aggressive approaches that we've seen in China in multiple fronts? Or is it really something that, it's just a couple of large countries that happen to be in a lane that me and, a lot of folks on this line would necessarily be following?
Yeah, I think this is a really important point, because I think, when we think about the global backdrop right now, it's very much focused on COVID-19 and the economic impact and kind of the science side of that story, when we're going to have a vaccine. But before, let's call it January, December, when COVID wasn't on the radar at all, the dominant story on the global outlook was really this US-China tension and the extent to which that would spill over to the rest of the world. And going back even further than that, there's been a lot of discussion about a tech winter, decoupling, these forces that were really kind of had the potential of bifurcating the economy, the global economy, and forcing third countries to either choose a side or just take an entirely separate path. As economists, I'm guessing there's going to be a bias toward a view of erecting these sorts of barriers are actually bad for growth, actually weigh on efficiency. And so that as a backdrop, this kind of tension and competition, which would force a bifurcation, is actually, I would say, negative overall for global growth. The way that it plays out for India is an interesting question. I'd be really interested to hear how Bill and Joydeep and you, Rick, think about this as well, because as you know, there's been tension, longstanding tension between India and China. There have been efforts, including under the Trump administration, to really pull India more into kind of the US side of the equation. But alongside of that, there's been what I observe kind of as a more casual observer of India, a will or desire to go kind of a third way. And in particular on the technology front, and Joydeep mentioned this, in digitalization, India is rightfully a leader in some of these areas, in areas of digital identity. Obviously, a number of tech powerhouses there. And it's a question mark, I think, about whether India goes kind of its own third way or is pulled more in alignment with US, Japan, Australia, you know, there's the talk of the Quad there. I think this is a really important question because it's clear that we are in the middle of a tech competition. I think it's a mistake to think of that tech competition as one that is only between the US and China. I think India, Europe are other very important players of this. And, you know, the winner, to the extent there is a winner in terms of standard setters, I think that will be an important input into things like growth potential, what Bill was talking about in his answer.
Yeah. Well, you kind of threw a question over then to the other panelists. I'll just say, you know, kind of briefly on this about, you know, I think that India is choosing, you know, to more closely align with the United States on defense and security when they think about threats that China poses. But on econ, I think the only issue that I've seen really sort of brought up at a high level is, you know, trying to get India to buy into the U.S. line on 5G, but other areas where India has taken its own steps on data flows and things like that. You know, I think these fights and arguments are happening very much independently of like a common perceived threat or something. I don't know, Bill or Joydeep, if you have any thoughts on U.S. India and how China kind of looms in the corner and what you kind of look in the space.
Bill, you want to start?
Sure. I mean, the most direct way from a sovereign ratings perspective we think about these issues is, you know, geopolitical, really. There's the economic angle, which we can go into. That really has to do with trade relations, investments, you know, technology partnerships, etc. But the most obvious is geopolitical, and obviously that's really front of mind right now with regards to China and India, given the border dispute flare-up that we've seen. And the big question moving forward is this a permanent change of a more contentious border with potentially military escalation, similar to what we see on the Pakistan border in Kashmir? Or is this just what we've seen in the past, ultimately with China is every so often something flares up and then ultimately it subsides? That is very much an open question right now. And obviously China is under a different regime today under Xi Jinping than it has been in the past. And India is under a different regime under Prime Minister Modi. And so these two strong leaders ultimately may be in a position now where there's going to be you know, greater attention to this border than in the past, and ultimately it's going to be more complicated. If that's the case, and if there continues to be military action on the border, that's how we think about it in terms of, you know, risks to potentially from an India perspective, the Indian economy, India policy making. If we see something that ultimately becomes something that requires a lot more attention from policymakers, distracts them from the day-to-day operations of focusing on the domestic economy and the things that we focus on, that could be considered as higher geopolitical risk. And ultimately, certainly when we look at India, the geopolitical risk factor is Pakistan. But the Indian economy is so large and diversified, and ultimately, despite having that tense border dispute with Pakistan, we don't see that as having a meaningful impact on the Indian economy or policymaking to the extent that it would derail it in any significant way. And so geopolitical risk on a relative basis, we think, is lower in India than it is in Pakistan, for example, which is a smaller economy. Also, Pakistan has its own issues with a history of military coups. You don't have that in India. But adding another layer to this with China is a very interesting potential dynamic in the future. It will complicate things for India, and we'll continue to watch that from a risk perspective.
Thanks. Joydeep, anything you want to add on?
Sure. Yeah, I think Bill gave a very good overview of how to look at that situation. I would just add one thing, just sort of off to the side a little bit. India has a large trading relationship with China, investment relationship, many other things. And obviously, at the same time, you have this border conflict. One of the things to look at is how the debate goes on inside India between those who seek to put in barriers, whether it's getting rid of TikTok or trade barriers aimed at China, and also others who want to build up domestic capacity in digitization, regardless of the China issue. And at the same time, on the other side, there's a risk that protectionism will undermine the whole strategy for having industrial growth, GDP growth in the future. It's a very difficult situation because I don't think you can argue for, status quo with a country where you just had 20 of your soldiers killed. No country in the world would sit back and do nothing. On the other hand, if you do things, you might also hurt yourself economically. And whatever you do in terms of economic measures, are they specifically directed at China or anybody else specifically, or are they going to have a general impact and result in a more closed economy than in the past? So I think there's a debate going on in India on the details of how to respond to this. And the answer is not obvious, but I think this is something to look for in terms of how they maintain their openness and hopefully increase their openness in certain areas while doing whatever is politically necessary because of the issues with China. And it's a delicate balance. And one way or the other, this could have a huge long-term impact because the upside is clearly there. There's a value in having that strategic relationship with other countries and the Quad, but there's also a loss in abruptly cutting ties with China.
Well, we got about a little over 20 minutes left to go in the session. And luckily, a lot of the questions people are sending in track pretty well with some of the things that we talked about ahead of time for the Q&A session. One that we've actually had a couple of questions on already, Joydeep, I'm going to ask you about is, we've talked a lot about the central government, but of course in India, as you really kind of opened my eyes to many years ago, the states are incredibly powerful. And, I wonder if you can talk a bit as you look at, both wearing your ratings hat, but as somebody that's tracked the Indian economy for a long time, how you look at the role of states. Is it evolving over time? Are there winners and laggards? I mean, how do you kind of mix between, the power that the central government holds and states holds and how they work together or not to pull themselves out of the economic doldrums right now?
Yeah, federalism in India is always going to be a messy subject with lots of arguments on both sides. I think the best way to look at it is, again, very, very long term. If you go back to, say, the 1990s, when the economy is liberalized, the intention was to liberalize the economy, but the unintended consequence was actually to give more powers to the state because you didn't have to go to Delhi for permission for everything. And that led some states to move ahead faster, and some states didn't move ahead because they just didn't respond. And there you had differential responses. The good news is that the states change over time. So states that were at one time considered to be the leaders, think of, say, Andhra Pradesh back in the early decade of this century, no longer considered to be the leader, and other states have sort of caught up. Second thing to note is the 14th Finance Commission, about, I guess, 5 years ago, made a very important decision to give more free money to the states, free meaning not attached with strings as to what they must do with it. And that has had a long-term implication in terms of just giving more autonomy for the states to make up their own mind. Third thing to note is that the return of a strong, powerful majority government in New Delhi pushed the weight in the other direction because you had weak coalition governments for almost 20, 30 years. States could take more power because they had some influence in the national coalition. Now they don't. So in some ways you could say the center has picked up more power by being stronger. But I think the long-term trend is clearly greater economic decentralization towards the state, but there's going to be some step backs back and forth. At the moment, for example, most of the states are dependent on the national government for funding because their borrowings are ultimately capped by the national government. And so they have to respond to national government initiatives if they want to borrow more money. And that's causing a lot of pain and a lot of complaints. So during the crisis, there's been somewhat of a centralization of things. Probably a year or two from now, it's going to be very different. So I think you're going to see ups and downs, but the direction is clear. States are going to be more powerful gradually in economic matters. And fortunately, you do see states deliver. And many of the good things that you can talk about, including initiatives like digitization or direct benefit transfers or some of the new healthcare initiatives, if you look at what the national government is doing, many a time, there's a state government that had that program beforehand and it worked. And then Delhi picked it up and nationalized it. That's good. So there is some benefit in this trend, but this tension is going to be around forever.
Yeah. Well, we're seeing that with some of the, one of the reforms that Bill had mentioned on labor reforms. A number of states have went ahead and amended the Industrial Disputes Act and widened the space for companies to do layoffs. And they've actually seen company size grow. Employment has grown. So, again, that great thought you had, Joydeep, on, the center can learn from the states sometimes. Some of the most difficult reforms, like labor, maybe states are the laboratories there. So I love that point. Bill, let me throw you over. I mean, if we can turn back the clock a little bit, Bill Foster heading out to Delhi as Treasury representative those days, thinking what we learned on COVID right now, are there areas, that you think that the United States and India should maybe have a little bit deeper cooperation? Anything that's kind of triggered for you, where if you could advise your former colleagues at Treasury on new initiatives that we should be working on bilaterally, whether directly related to COVID or just other things that are springing from it. Any kind of thoughts on how this might shape U.S.-India engagement, particularly from Treasury to Finance?
Well, of course, you have an election coming up in the U.S. in November, so I think that's going to really set the tone of sorts in terms of attention to that bilateral relationship and what the issues will be. But I think what's very clear from previous administrations and today is that the economic development agenda for India is of really tremendous importance, not just to India, but also to the U.S. And so I think from a looking to the future perspective, any U.S. administration should focus very much on, I think, commonalities, common interests with regards to India's economic development and ways that they can collaborate and work together to make the Indian economy more dynamic, stronger, and foster that sustainable growth that we talked about earlier. That's really needed for India to succeed in terms of its own economic destiny, but also just become the world player that it can be. And part of that is integrating with global supply chains. And as you mentioned earlier in this conversation, opportunities in terms of, China is maturing as an economy, and therefore there's opportunities for other countries to step in. India should absolutely be one of those countries. So I think, working post-COVID together on ways that there's overlap and common interests for getting potential growth up in India, and that includes through measures that develop an export-oriented manufacturing sector in India, and ways that foreign investment from U.S. and other firms can contribute to that. All of that requires collaboration, cooperation, and a commitment to reforms on the Indian side, but also to meeting India halfway from the U.S. side on various asks. And that has not been easy to do in the past, as Rick, you know very well, and Joydeep knows well. But there's certainly a lot of importance around that issue for both countries, and certainly for India, particularly given the growth is as low as it is now, and there's a need for not just creation of jobs to keep up with demographics, but also higher quality jobs, and to meet the aspirations of the growing Indian young population. So I think that's key. I mean, one of the things to point out, with regards to COVID in particular, the U.S. obviously is really struggling right now. We're the world leader in cases. India is third behind Brazil. But when you look at it on a population basis, the U.S. currently is 10 times worse in terms of the number of COVID cases relative to the population compared to India. So, the health services sector, looking at, the pharmaceutical sector, just the broader medical and health services sector is an area, obviously coming out of COVID in particular, where there should be tremendous discussion and opportunities for both countries to explore what happened during this pandemic, and are there ways to work together to try to strengthen preventativeness and ultimately responsiveness to a pandemic in the future, and just general healthcare and inequality needs, as Stephanie very rightly pointed out. That's another issue we're dealing with very significantly in the U.S. And then obviously there's tremendous inequality in India, very different levels of per capita GDP and for different reasons, but this is a common issue that policymakers have to grapple with. So perhaps there's opportunity there as well.
One of the questions we received from a participant is talking about infrastructure investment, particularly renewables. But So this could be either for Bill or for Joydeep, if you want to kind of touch on opportunities for investment in these spaces. I also think it's kind of interesting, you do hear a lot about governments talking about sort of spending the way out of an economic slowdown, and infrastructure obviously is one of the things to look at. So if the Indian government looks at a big infrastructure spend program, does that close the door for private investment in those areas, open the door? But more broadly, I mean, do you think that it's an attractive environment right now for infrastructure investment, and particularly with renewables? Anything you're kind of looking at in this space? Again, this could be either Bill or Joy, depending who wants to lead off and take it.
Sure. I don't have a lot to say. I mean, Rick, you know the answer better than I do, I think, given your own work on this area. But the renewables, I mean, there has been a strong commitment to renewable energy in India, and it's not partisan. I think everyone sort of agrees with it. And there have been ups and downs, as you know very well, in terms of some of the projects. But I think this is an area where it would be easier for the government to make way for private investment. You know, there are certain things which are difficult to manage in public-private partnerships. There are certain kind of projects that are just more complicated and run into more problems. And we've seen plenty of examples of such projects in India. But I think there have been also quite a few examples of successful renewable projects in India. As you know, the state governments are key to some of these projects because they're often the off-taker, or they can become the impediment, including sometimes changing contracts that the bidders had signed. So there are a lot of complications in there, but I think this probably is one of the more optimistic areas in terms of the barriers should not be that high. And if you have a good commitment from the state government, and certainly I think there is a good commitment from the national government, you can get a lot of private money into the sector relatively quickly and without causing too many disturbances as other types of projects. So I'm cautiously optimistic on that one.
Bill, anything you want to add on infrastructure?
Yeah, I would just add, Rick, that one thing that I think this is true anywhere in the world, and this is certainly something that I've seen in India over the years, is when you involve the private sector in infrastructure projects, pricing sensitivity, design of the project is really important. And ultimately, for private capital to come in, there needs to be a return on investment. It needs to be relatively, relative to the risk-free rate, it has to be worth the price of that risk. And I think historically in India, that's been more of a challenge for various reasons. But moving forward, if you're going to see, capital coming in, and what we have seen in India is long-term capital from pension funds, from insurance companies and the like that have a much longer term view. There has been some money coming in, and India's been doing more, I think, to attract that capital. But for really, there's a huge opportunity in India. There's a tremendous infrastructure deficit, tremendous opportunity. But I think for that to really take off to the extent that it could, there needs to be probably more of a realization around the cost of capital and optimizing pricing in a way that's that is attractive to investors, while also providing what the Indian government and the Indian populace need.
Good. Well, one issue that you touched on just briefly, Bill, and maybe I'll ask Joydeep to spend a minute on this since you hit on it already, Bill, is the youth. I think we talked 6-7 years ago. Every conversation kind of began and ended with this idea of 1 million new folks entering the workforce every single month in India. When we talk about some of these shifts that you were talking about happening in India, political and tied to econ and who Prime Minister Moody and the BJP were talking to, where do you think youth fits in right now? Do they look at this as new opportunities? Potentially on the side of COVID, are there sectors? Are there things you're seeing that are going to really help to absorb that labor bulge market that you're seeing right now, or is that still an area that needs a lot of work and attention?
Well, we always talked about the demographic dividend, right? That was the kind of term that we used, that ultimately this was going to power India in the future to high levels of potential growth. And what we're seeing today is that, unfortunately, job creation is just not keeping a pace with the demographics. And as I referenced earlier, not only just the volume of jobs, but the quality of jobs is not commensurate with what it should be. And certainly it's not meeting the expectations of the young population of India that's going to continue to grow. This current administration came in during its first term on a platform of good governance and growth. And there was a young Indian population that really resonated with, and focusing on job creation and growth through people working and creating incomes for themselves. That's fallen short, I think, relative to what had been intended. And the question is, how do you get things closer to what they could be in India? And I think that ultimately, the jury is very much still out, Rick, on where things are going to end up, because there's equal opportunity and equal risk on the downside. But it's very clear that there needs to be reforms that create greater opportunities for low-skill manufacturing in India, to provide opportunities for a migration from the agricultural sector in India, which is very inefficient, to allow for people to come toward more semi-urban, urban areas and work in manufacturing, work in areas where they can earn a higher wage and ultimately contribute to that higher income and higher quality jobs they're looking for, along with educational reforms. So to ensure that vocational training is available, not just the IITs of the world that are obviously world-class and providing, we have engineers and management trainees coming out of India that are absolutely top-notch, but there's so many other needs within India, right, from a vocational basis, and the current skilling programs are working toward trying to accommodate that, and there's been a lot of attention from the government trying to focus on those human capital needs. But there's still a mismatch between the needs of the economy, of the private sector, and what the training is producing in terms of skill sets. So, there's going to need to be a lot more work that continues to be done on this front, because ultimately the results thus far have been falling short of the need. And that's going to be a really big decider moving forward in terms of whether India can achieve the potential growth rates that it needs to in the future.
Joydeep?
To just add one thing, I think Bill did a very good job describing this situation. The first term of Modi's, during those 5 years, job creation wasn't great and economic growth did decline. Job creation wasn't horrible either, but it just wasn't enough given the demographics. Nevertheless, he got reelected with a bigger majority. And I think part of that is this group that you described, the new aspirational younger generation. I think they still have hope, or they're giving him time, they're giving him some credit that he will deliver. And you could say, strictly speaking, he didn't deliver in the first 5 years. I think this would be the threat for him in 2024. It's hard to predict political futures, but given that there's no real strong opposition on the horizon right now in terms of opposition parties or leaders, I think this would be the threat, that the nationalist base might be happy with what he's done for their agenda. But if this aspirational generation and their parents and friends feel that, no, we've given you enough time, you haven't delivered, there's not enough, I think that would be the main threat for his reelection.
Let me ask one question that came through that I think is relevant for all three. Stephanie, let me ask you to kind of tee off on the idea of trade deals. Again, those of us kind of stuck in the U.S. India lane, we see two countries that seem to be kind of moving away from trade agreements overall. India, of course, had a number of trade agreements pending, as Modi came into office. Europe, RCEP, Australia, Canada, on and on. And really all those are either dead or floundering, or in the case of RCEP, India sort of backed out. What's kind of your sense, Stephanie, in terms of U.S. engagement on trade agreements? Do you think that there's going to be, a snapback at some point, more interest in engagement? Do you think that we're going to be in this for a bit of a longer period? Kind of appreciate your perspective before we kind of hone in on a little bit on the India lane.
Yeah, no, this is a really important question, and I think the direction of travel, regrettably, is in the direction of more protectionism. And if you even think of some of the quote unquote trade agreements that have been struck recently or reformed, I think they've gone more in the direction of managed trade. So not necessarily in the direction of greater liberalization, but really managing trade. I think that's a function of a country at the center of the system, but I think it's also a reflection of the fact that the multilateral mechanism that's there, the WTO, intended to address some of the tensions in the global system, for a number of reasons, have not been fit to purpose and not been modernized to deal with issues around services and digital trade. And as a result of that, I think countries have been looking more inward, and this protectionist tendency has really been ascendant in a number of countries. So that's not a particularly hopeful outlook, but I also think a lot does depend on what happens in the US election. I don't think that there's going to be a big headline and overt push for more trade deals, but you are hearing discussion about, could the US come back to the TPP, now the CPTPP, and could that be expanded? And I think maybe approaching trade from a kind of strategic perspective and thinking about how trade can actually deepen alliances, I think that has the tendency or the potential to maybe kind of reverse this protectionist trend that we've seen.
Bill, Joydeep, any thoughts? I mean, when you think about India, ratings, long-term future, does the walk away from a lot of these trade agreements and stepping back from trade integration, is it meaningful, or is that sort of icing on the cake that would improve things rather than sort of harm it as they begin? They've been retracting in recent years. Bill, let me throw it over to you first.
From our perspective, it's really par for the course. I mean, this is what you would expect with India. It's consistent with the past. So I think any movement on that front would be potentially positive, but it really has to, one has to kind of think through what's the pros and cons ultimately. But I think the main thing is that if India is going to achieve higher growth potentials, I keep mentioning, part of that is going to ultimately have to be driven through a stronger manufacturing base that's export oriented. And the government knows this. The whole Make in India campaign was based on this concept, right? And that's also how there would be a potentially a surge in job creation and foreign investment. To do that, I think India needs to be more integrated in global supply chain in certain ways, and trade agreements is one path toward that. So I think there's a real macro argument and growth argument as to why these could pursuing these in earnest, perhaps with more flexibility than in the past, might be in India's best interest. But of course, as we know very well, there's political economy issues in India that are very real, particularly when you talk about the agricultural sector, that make it difficult for any Indian government to contemplate big changes. But there's always opportunity for that to change in the past. But this has been the case with India for many years. So we're not putting too much weight into that.
Joydeep, any difference of opinion on that, or would you kind of echo?
I shared the moderate pessimism of the last two speakers on that issue.
Yeah. Well, we're running up against the hour here, but let me throw one over to Stephanie to kind of wrap us up here. Even though it's still a bit in the future, but we're a year and a half away from India taking over presidency of the G20. With China tensions, with the trade issues, with COVID, with everything we talked about here, is there anything that India should be thinking about today as they begin thinking about crafting the agenda for its leadership at this important body?
Yeah, I think there's a lot for India to be thinking about today, and it does. I mean, I think we're talking about the 2022 year effectively, which sounds like a long way off, but Saudi is about to pass the baton to Italy as G20 chair, and then I think it's around 18 months or so, India will be taking on the presidency. Unfortunately, I think there's a very good chance that COVID will still be with us at that point. So I think the G20 is going to have to prioritize COVID-19 and a number of aspects of COVID, my guess is that we're still going to be looking at economic recovery and some of the legacy issues we were talking about, the debt overhang. I also think the issue of vaccines and fair distribution of vaccines is going to be an issue that is perfect for the G20 to engage in. And India, I think, could be very motivated, both as a large country with great needs, but also with pharmaceutical and healthcare capacity to provide some leadership on that issue. And I think the issue of recovery as relates to what we were just talking about on the protectionist front. So the G20 really got its legs and was kind of crowned or anointed as the leading convening grouping on economic issues coming out of the global financial crisis, largely because of fear that the response to that would be greater protectionism. And given our conversation over the past hour and a half, I think that protectionism and pushing against protectionism, the G20 needs to take on that issue and engage in that issue. So that would be at the top of my list as well. One other issue, and again, I think India is well placed and is actually essential to making progress, is on the issue of environment and climate change. So much of the discussion when it comes to areas that the US and China could cooperate on, environment and climate is always highlighted. It should be US, China, and India. And India's involvement and leadership on that issue is going to be essential to actually forge global consensus. So that would be my other priority I would add to that list.
Well, thanks for that, Stephanie, and to Joydeep and to Bill. This has been a terrific conversation. I hope a year from now or so I can convince you all, and again, maybe we can do it in person. Stephanie, I think, kind of leading off with talking about some of the potential shapes of the recovery, but also I think importantly hitting on how this might impact inequality was an important kind of opening. Joydeep talking about some of the geological shifts that we see in India, politics and how that influences economic decision making was very important. And COVID, Bill, as you mentioned, sort of exacerbating some of the negativities that you saw. Prior reforms, implementation issues, obviously a very important issue. We covered to some extent center-state ties and what that kind of means. So really robust conversation and clearly very, very different from when we did this just a little over a year ago. So thanks again to my fellow panelists here and for everybody that dialed in as well. Really appreciated hearing from everybody. A lot of great questions, and I hope everybody stays safe and healthy. Thanks a lot.